We're going to look at the difference between a DSCR loan and a conventional loan for a rental property in this environment where rates are higher than they were a couple of years back, and looking at this with even a year or two time horizon to see if rates go down and what that actually has an impact on in terms of which loan you do today. And so what I've got is I've got a scenario for 285K, and you can see up top here, we've got a conventional loan with 20 and 25% down. I've got rates in here of 7.25%, 7%, and this assumes 2 points as part of closing. And again, this is not a quote, it's just an example to show you the differences in these scenarios. So not a state, not an APR, just looking at the raw data. And so all the way to the right, you can see I put in some estimated rents, taxes, and insurance, and rents versus payment, $879, $1,000 left over. Now, these are a scenario kind of in the Midwest in terms of taxes and insurance, and I did use some rental numbers that were based on Airbnb numbers for a certain scenario. So the rents versus payment, take that for what it is with a grain of salt. If you come back over here and look at the next scenario, it's DSCR. So we're only going to be looking at the rents in terms of qualifying. So the conventional option up here, we're looking at the overall profile, someone's income to debt ratios, credit scores, all this stuff. DSCR, we're looking at just the rents in the property. And, we're looking at that DSCR percentage. Does the mortgage get paid by the rents? If you're over one, rents versus mortgage, you're going to be in pretty good shape. And what you can see here is that the rates are going to be higher. And when you put 20% down, 8% versus 8.375%, the difference is the prepay. On a DSCR loan, there's a prepay, and this is one example with one of our investors. If you pay off the loan early, you've got a 5% prepayment fee that gets tacked onto your balance. On a conventional loan, you don't have that. Now, there are different prepay options. There's a 5-year prepay, a 3-year prepay. This is just a 2 and a 1. And there are step down options that over time can adjust over the time horizon. But I use a simple scenario with a flat 5% prepay. And as you can see here, the longer the prepay, the lower the rate. In this scenario, you've got a difference of 0.3%. And the difference in payment, which ends up being about $60 difference in payment. And if you put 25% down in this scenario, you're going to see a pretty decent reduction in rates. So 25% down, you're talking 71K. Now that rate, instead of 8%, now you're at 7.375. And the payment difference, you're talking almost $200 difference. So the rates are lower and you put more money down. Now, deciding whether to do a conventional versus a DSCR loan, when you look at these prepays, this is the 2-year scenario. So if rates are lower within a year, and sometimes you don't know if rates are going to go up or go down, and if you want to capitalize on that time period, if you do it at that point, you're going to have this prepay that gets tacked onto your closing cost. So when you look at the idea of, okay, what if rates go down a full percent after, say, a year, which again, no one knows is going to happen, but just to be able to look at the difference in payment, you can see on this first scenario, conventional, 7.25, P&I of 15.55. If you come down here on this refinance, now we're going down to 6.25. It's a savings of about $165. I actually did this on Florida, and there are transfer taxes that come into play in Florida. So again, just a scenario. So you're talking about lender fees, points, title fees, transfer recording, appraisal fees not included in this. Again, just to make things simple, I do have a break-even calculator in here. So in all reality, rates may have to go down further than 1% to really have a major impact. So you can see 165 reduction in payment, 153 in this scenario. And then the DSCR scenarios obviously going to have their own sets of numbers. And so what happens if rates stay flat? Well, you know, at that point, it is what it is. If rates go down significantly, what's the amount that the rates need to go down by to be able to make a refinance worthwhile? My rule of thumb is typically if you can break even within 3 years, maybe it's worth looking at. But it just depends on someone's preference and time horizon. And so the DSCR loan, again, is going to be on someone's LLC, not on their personal profile. Conventional is on their personal profile. You're going to verify things on their full debt to income ratio guidelines. So if you have questions on this kind of stuff, if you want a scenario built out for your deal, please go ahead and reach me at 314-956-1580. You can text me and we can help you put some numbers together.